Hello everyone. The topic for today's video is fire insurance claim. Let us first of all see the introduction. In fire insurance claim, there are two types of loss. First one, loss of stock. Stock or inventory or goods are the things which a businessman keeps in sufficient quantity for the smooth running of the business. These stocks are considered as asset as per accounting standard 2. Due to any unforeseen circumstances, for example fire, if the goods gets destroyed, that is called as loss of stock. Second one is loss of profit. Loss of profit refers to the monetary loss which occurs due to the breakdown in business activity that has arisen due to the physical destruction of property by fire. Now, let us consider the concept of loss of stock in detail. Imagine you are a businessman in whose godown or storehouse at any point of time goods or stock are stocked in sufficient quantity. One fine day, fire occurs in your godown. The moment you get the news of fire, your BP shoots up. But if the businessman has taken insurance policy and that too a fire insurance policy, then in that case he can claim the loss suffered by him due to fire from the insurance company. I hope this loss of stock concept you must have got some idea about it. Now let us see the procedure of claim for loss of stock. Here we may come across with any of the given two situations. Situation 1, if the proper stock records are maintained and if it is saved from the fire, in such a situation it becomes easy to find out the loss of stock due to fire. Situation number 2, if the proper stock records are not maintained or if such records are maintained but they are destroyed by fire, then in such a situation we have to work out the loss of stock due to fire. Now we are going to study in detail situation 2, that is if proper stock records are not maintained or if such records are maintained but they are destroyed by fire. In such a situation, how to calculate claim? My dear friends, there are 4 steps involved in the calculation of claim. Step number 1, calculation of gross profit ratio. Step number 2, calculation of stock on the date of fire. Step number 3, calculation of loss by fire. And step number 4, computation of claim. Now we will be seeing all the steps one by one. So first of all, step number 1, that is calculation of gross profit ratio. Now my dear friends, here we may come across with two different situations. Situation 1, if gross profit ratio is given in the problem, that is it is readily available in the problem. In that case, how to present it? Then gross profit ratio is whatever ratio is given in the problem. For example, if in the problem it is given that gross profit ratio is 30%, then we will write down like this: gross profit is equal to 30%. If it is given 20%, then we will write down gross profit is equal to 20%. Otherwise, we will proceed towards situation 2, that is if gross profit ratio is not given in the problem, then in that case we have to find out gross profit with the help of trading account. Now let us see the format of trading account. Now trading account has two sides, debit side and credit side. On the debit side, we have to take down opening stock, purchases, that is net purchases, wages, direct expenses. On the credit side, we have to take down sales, that is net sales, then goods distributed as free sample, goods taken by proprietor and closing stock. After taking down all these things, when we close down our trading account, we will get a balancing figure. And that balancing figure is called as gross profit. But my dear friends, our step number 1 is still not over, because here our intention is not to find out gross profit, but our main intention is to find out gross profit ratio. So now with the help of this gross profit, we have to find out gross profit ratio. And the formula for the gross profit ratio is gross profit upon net sales into 100. Gross profit we will get from our debit side and net sales we will get from our credit side of trading account. Once we will get from this gross profit ratio, our step number 1 is over. Now let us proceed towards step number 2, that is calculation of stock on the date of fire. Now here for this we have to prepare memorandum trading account. Now you must be thinking, what is the difference between trading account and memorandum trading account? Trading account covers full 12 months transaction, whereas memorandum trading account does not cover full 12 months transaction, because it is not necessary that the fire will take place at the end of the year. It can take place at any point of time during the financial year. And as per the insurance company, once the event has occurred, within 15 days claim has to be filed with the insurance company. So here, when the fire has taken place, within 15 days the claim has to be submitted by the businessman to the insurance company. So he has to find out what was the value of the stock as on that particular date when the fire has taken place. For that, he will be preparing memorandum trading account. Now this memorandum trading account will cover all those transactions which has taken place right from the beginning of current financial year till the date of fire. My dear friends, you heard it correctly, till the date of fire. Now what all things this memorandum trading account will cover? Let us see. Now memorandum trading account is just like your normal trading account. So on the debit side we will be having opening stock, net purchases, carriage inward, wages, direct expenses. On the credit side we will be having net sales, goods distributed as free sample, goods taken by proprietor, goods sent on approval, goods sent on consignment. After taking down till here, then we have to calculate gross profit. My dear friends, normally gross profit is the balancing figure from the trading account. But in case of memorandum trading account, gross profit is not the balancing figure. It is some other figure which is going to be the balancing figure. Then in that case, how to calculate gross profit? Now here we have to refer our step number 1, that is gross profit ratio. Now with the help of that gross profit ratio, we will get the gross profit for that memorandum trading account. Say for example, if the net sale figure is 9 lakhs and the gross profit ratio is 30%. So 30% of 9 lakhs, so that comes to rupees 2,70,000. So our gross profit is rupees 2,70,000. Now once this figure is calculated, then when we close down this account, we will get a balancing figure on the credit side, and that is called as stock on the date of fire. Now by this, step number 2 gets over. Now let's proceed towards step number 3. Now step number 3 is calculation of loss by fire. Now the very first thing which we have to take down for the calculation is stock on the date of fire. Now the stock on the date of fire we will get from our step number 2. Now in this we had to add abnormal goods. Now what is this abnormal goods? Abnormal goods are those goods which are slow moving items or abnormal items or outdated goods, or it can be a defective goods. From this we have to deduct salvage. Now salvage refers to those goods which are saved from fire completely or partially. Then we have to add firefighting expenses. Firefighting expenses are those expenses which are incurred to control the fire. Now after doing all this add less, we will get loss by fire. So by this our step number 3 also gets over. Now proceeding towards step number 4, that is computation of claim. Now here we may come across with two situations. Situation number 1, if there is no average clause, or if there is average clause but there is no under insurance of goods or stock. Now you must be thinking, what is average clause and under insurance? Let me explain that concept first of all. Average clause is the clause introduced by the insurance company to discourage under insurance of goods by the businessman. Now under insurance of goods means where the goods are not adequately insured against the loss. Now in case if the goods are not underinsured, that is it is properly insured and no average clause is applicable, then in that case claim is equal to stock loss by fire. Now the figure which we will get from our step number 3, say for example, our loss by fire is rupees 1,25,000. Then in case if there is no average clause and no under insurance is there, then claim is equal to rupees 1,25,000. But if goods are underinsured and average clause is applicable, then situation 2 will be there. Then in that case, claim is calculated with the help of a formula, and the formula is value of policy upon value of stock on the date of fire multiplied by value of stock destroyed. Now value of policy refers to the policy amount or sum insured which will be given in the problem. Value of stock on the date of fire we will get from step number 2. Value of stock destroyed we will get from step number 3. Once we will put all these figures into the formula, we will get the claim amount. I hope you understood properly fire insurance claim. Thank you.